November 6th, 2023. Today we got a measure move down of the opening range from here. Some bulls would argue, or some traders would argue, that it's a wedge down, right? So it's an attempt at a bull flag. So one, pullback, two, pullback, three. So it's an attempt at a bull flag. When you get an attempt at a bull flag, then a breakout below the bull flag, you oftentimes get a measure move down of the bull flag. So you could look at this as a measure move of the opening range, or you could look at this as a breakout below a bull flag and a measure move down to the opening of the bull flag. Doesn't really matter either way. Brings you to the low of the day. And I think something else that's interesting is you have to keep in mind that the open of the day is always going to be a target on a trading range day. And even when we're going down here, look how strong these two bull bars are. This isn't that strong, but it closes on its high. Strong bull bar closing on its high. Big bull bars early in the day. These are all hints that the day is going to be a trading range day. And if the day is going to be a trading range day, the open of the day is going to be a magnet. So it was reasonable to look for a swing up to get to that magnet. And, the market will often create a lot of reasons for it to go to that open of the day. You can see we got a trading range from 47 to essentially 60. But I think 60 is where the swing started. But you could argue the swing started on 47 since it never traded below it. But the problem with buying above 47 is it's a tight bear channel, so it might need another leg down. But I still think it's okay. But this trading range here, we ended up getting a measured move up of, and look where it is, the open of the day. If you take 47, if you're buying above 47, it's a low probability trade, so you need good risk reward. What's a 2-to-1 of bar 47? The open of the day. So there's all these magnets that end up being around the same price, the open of the day, these measured moves, and it all creates more and more reasons for us to get to this magnet, which is the open of the day, as it often is a magnet on trading range days. And I wanted to go over actually the end of the day first, because I thought something really interesting happened at the end of the day. So if you're an always in bull, let's say you're long above 60 or above 61 or wherever you're long, you probably are going to be willing to get out below 64 if it triggers. It's one, pullback, two, pullback, three. So it's potentially a parabolic wedge. So it makes sense to exit below 64 if 64 triggers. For that reason, a lot of bulls will buy the close of 64, hoping it doesn't trigger, risking 2 or 3 ticks trying to get to the open of the day. So they're risking 2 or 3 ticks to make 6 points. It's not, it's good math. It's low probability. It's maybe only 10, 20% or probably 20%, but, it's pretty reasonable. It's a reasonable trader's equation. So traders will do that. And once you get 65 and 66, a lot of traders will move their stop below 64, thinking that, well, if we trade back down here, my premise that we're going to the open of the day is not all that valid. And so 69 tried to trade up and raise towards the open of the day, but we ended up getting a big failure. And a lot of traders might have to exit below 69, but it doesn't trigger on 70 because those traders are doing the exact same thing. They're buying this close, hoping that we're going to get here without trading below. Traders are buying the close of 70, hoping we're going to get here. Sorry, they're buying the close of 69, hoping we're going to get here without trading below 70 or without trading below 69. And then when we got 71, that's disappointing for a lot of traders who have their stops below here. A lot of them get stopped out. Some bulls would have their stop below this bar, but that's kind of hard to do once you see 69 because it's either probably exit below 69 or keep your stop down here. But either way, even if your stop is down here, you can see those stops get run during 75. And then once those stops get run, suddenly we start to rally up. And traders who were long, hoping we were going to get here, were disappointed and got stopped out by the, probably, take your pick, 74 or 75. I assume a lot of the traders who had their stops here or here are all stopped out now. And then we start to rally, and traders are worried that they're about to get trapped out of a big move. And so they'll start buying the market, and they'll start buying the market thinking that we're going to go rally right up to here. And that's exactly what happens on 78. So that's why you get this big bar on 78. And you can see 79 tests right back down to the open of the day. So we're oscillating around that price to finish the day. But that's what's happening here is traders get trapped out. Their stops are down here or here or here. It's difficult to have a stop way down here because you're risking so much towards the end of the day. So a lot of traders get stopped out pretty quickly, and then they're buying back their longs in a panic, hoping that we're going to end up getting a rally, which we did end up getting. I mentioned in a post that I have had a pretty sore throat for the past few days. I don't think I'm going to end up making up the past couple of days that I missed, but I should be good to go from here on out. It's still pretty sore, so if I end up missing a day or two this week, that's why. But I think I'm good enough to do today. We have a bull bar on the open with a big tail on the top. and then an inside bar on bar 2. Occasionally, you'll get an inside bar on the open, and that'll be the low of the day. Good example. Yesterday, you can see we got this bull bar and then an inside bar on the open and a rally, and that ends up being the low of the day. Today was the high of the day. I think that in general, it's better to wait for more price action before taking, especially if it's like the bad inside bar like this with big tail on the top. If it's a good one, you can occasionally take it for a swing, but it's a low probability that it's the low of the day, maybe 20%. But with the context on the daily chart, we're pretty overbought in general, so that decreases the probability that bar 2 is going to end up being the low of the day. I would say, on the close of bar 2, maybe 15% chance instead of 20 or 25% chance that bar 2 ends up being the low of the day and we just rally straight up. That's one of the reasons why you get a big bear bar on bar 3, because there's a lack of bulls willing to buy up here. You can see these big tails on the top and some sort of micro double top. Bulls are willing to buy below 1 and 2 though, expecting that any sort of reversal down is going to fail and get another leg up. You have to be paying attention to this close. It's possible that we're going to get a vacuum test down here and then a bounce, and that's pretty much exactly what happened on 9. 9 is a big bear bar, and it's tempting to think that you're getting a breakout below this high 2, right? So you get a high 1 here and a high 2. And some traders are hoping that we're going to get a big measured move down to somewhere down here, and they're selling the close of 9, eager, hoping we're going to get down there. But that's a mistake, because the reality is 9 is probably just a vacuum test of 78, which is what this was. This is the 78 close, because sell the close bears, they did a reasonable thing selling this close in a sell the close bear trend. So you'd expect them to be able to have a chance to get out at break even, and that's exactly what's happening on 9. So I think 10, there are some bulls who are buying the close of 9, hoping that this is going to end up being a vacuum test. But a lot of this is just bears buying back shorts. The bulls are buying here. Any bulls buying here are buying because they think bears are about to buy back shorts. So I think 10 is mostly bears buying back shorts. But as I was mentioning, down on 3, but then up on 3, down on 4, but then up on 4. And you can see 4 touches to 2 low. So limit order bulls are able to make money. So bear trend, not all that strong. And you have big tails on 3 and a big tail on 4. So this is some sort of, micro double bottom or, two-legged correction on a smaller time frame. Doji bar on 5. Bulls wanted a good inside bar that they could buy above for a swing, but they don't get it. And then 6, bad follow through for any bulls who did buy above 5. Outside down on 7, but really not able to close very strong. Really not all that good. And we're forming a tight trading range here, and that's something that's really important to keep in mind. Another reversal attempt up on 8, but again, disappointing close, right? These bars are disappointing for the bulls. So a lot of bulls are giving up, and they're selling out of their longs during 9. Basically, selling out of their longs, accepting the fact that we're probably going to touch this magnet. When you have an obvious magnet like this and bulls keep being disappointed, they're disappointed pretty severely here twice. And they just give up and let us get to the magnet so that the bears can get out, and then they go from there. And that's one of the reasons why 9 happens. 10 is a good bull bar, but doesn't quite close on its high. It's an inside bar, and it does a good job of undoing 9, but this is a pretty tight bear channel. Excuse me. But this is a pretty tight bear channel, so I think that any rally here is probably going to be minor, and it's going to need to test back down. And that's kind of exactly what happens on 11. 11 tests the top of the tight trading range. You can see this is the tight trading range, essentially. Oh, wrong tool. At this point, at least, this is the tight trading range. And so we're going to oscillate in it. And we tried to get a breakout on 9, but the breakout failed 10. We're trying to get a breakout on 11, but you get to the top of the trading range and we find sellers. 12 does something really important. 12 trades below 11. So when 12 trades below 11, that immediately makes a lot of bulls think that any move up is going to end up just being a second leg trap. And that's why, 14 gets such disappointing follow through. But 12 trades below 11, it's essentially a high 1, but a big tail on the top, and it's better to just wait. And that's why essentially on 13 you get disappointing follow through. However, this is enough for a second leg up. So you would think that 14 is that second leg up. Oftentimes you get climactic second legs up in trading ranges, and trades look in trading ranges. The bulls look the strongest at the tops of trading ranges, and the bears look the strongest at the bottoms of trading ranges, and that's how they trap traders. And that's how you force quick moves to the other side, because you have traders that are trapped. 15, I think 15 is a good swing short. It's excuse me for a second. Like I was saying, 15 is a good swing short for a lot of reasons. It's a double top. It's a second leg trap. You could argue it's one pullback, two pullback, three. So you could argue it's a wedge or a second leg trap. In trading ranges, a lot of times you can see things as either two or three legs, and that's part of the reason why they're so confusing. But I think what's also important is that you have this tight trading range right here, and a lot of times you need to test back into the apex of the tight trading range. So it's a reasonable sell on 15, expecting that 14 is a failed breakout of the tight trading range, and you're going to get a move down on 15 back to at least the apex, which you do on 16. The Bears who sold below 15 were able to make 3 points during 16, and then they ended up taking profits, causing 17. Bears who were selling here were hoping that they were going to get a big swing down and lots of strong bear bars. 16 was a good start, but you can see they ended up scalping it because it's the middle of a tight trading range. And this, while it was, a two-legged correction, 14 is probably a strong enough bar to get its own second leg. You can see we got right back up to that high. So bulls who bought above 14 scaled in lower, were willing to buy more around the open of 14, and probably would have bought more below 14 had we traded below it. They are able to get out during 20 at exactly break even. That's what's happening up here. I'm going to get to that in a second, but disappointing follow through on 17. And then 18, big tail on top as well. 17 and 18 is an II pattern. So reasonable to think that we're going to try to get some sort of breakout. II patterns generally have a 50% chance of the first breakout failing. And you can see 19, an attempt up, but it's not all that good. I think always in bears who sold below 15 are probably getting out above 18. So it's possibly a reasonable buy above 18, but I don't think it's all that great. I think it's better to wait for more price action. And you get kind of disappointing follow through on 19 and then a deceptive bull bar on 20. And the bull bar is really just a vacuum test, like I said, of this 14 high, letting the bulls who bought above 14 out at break even. But you also have to see that it's one, pullback on 17, two, pullback on 18, three, pullback on 19, and then a breakout attempt of what's probably a wedge on a lower time frame during 20. So 20, a lot of reasons why there are probably sellers up here. Attempted breakout of a wedge, essentially the trend line, and it's getting parabolic. Kind of the same thing that happened over here. We had this trend line. Come on. There we go. And then it got parabolic. And when it gets parabolic, you can oftentimes look for the reversal up, which is another reason why I thought 47 was okay. But you have to be willing to hold through a pullback since this channel was so tight. 21, like I mentioned, because 20 is so disappointing, or because 20 is, climactic, it's a reasonable thing we're going to get sellers there, and that's what happens on 21. 22 is an inside bar and a high one, but it's a high one at the top of the trading range. It's potentially a third push up. If you're buying, you're hoping we're going to get a breakout of the 18 bar range, but it's not all that good. And one of the reasons you get these outside bars on like 23 is because if you buy above 22, you're going to give this about 10 seconds, right? This next bar, this is a 5-minute bar, but you're not going to give this very much time. If you're buying above 22 and we're going to break out to the top of the 18 bar range, you just kind of want it to go up. You want to see another bar like 14 in a climactic breakout. And when traders don't get that, a lot of them sell their longs pretty quickly, and that's what causes a bar like 23. 24 trades back up to the close, though, so any bulls who bought the close of 22, disappointed 23, sell out of their longs, disappointed during 24. 24 is probably a reasonable swing short, hoping for a breakout of the 18 bar range. Remember, 90% chance we're going to break out of this range, and the day is really small so far. At this point, the day was only 15 points, and the average daily range over the past 15 days has been 50.5 points. So I don't really think that we're going to stay in this range all day. So it's a reasonable swing sell below 24. The obvious problem with it is it's right on the moving averages and it's a doji bar. But as long as your premise is valid, I think it's okay to be short here and stay short. You get follow through on 25, but it's not all that great. And then you get an outside down bar on 26. Once you get the outside down bar, a lot of traders move their stops to above 26 because it's a lower high. And when you're trading always in, you move your stop. You move your stop with the lower highs if you're short. So traders move their stops to here, and they get more follow through on 27 and kind of disappointing follow through into tail on 28. There are tails on all these bars, so it makes this not as strong. And you're also at the bottom of a trading range now. And so when you get disappointing follow through on 29, a lot of bears buy back their shorts at the market, and that's what causes the rally on 30. Bears who are selling down here for any reason disappointed that 29 happened, bottom of trading range, buying back shorts, causing 30. But 30 runs the stops of the bears who move their stops to here. And that happens a lot in trading ranges. They run always in stops, and then it goes in your direction immediately after. So 30 runs the stops of those always in bears, and then we get 31, a bear bar closing kind of near its low, but above the moving average. So it's not as good. And a lot of times on trading ranges, range days, it'll be really hard to get in on trends like this because there's so many tails and so many issues with it. 31's probably an okay sell. It's a triangle, right, at this point. It's a triangle, and bears want more follow through. But it's if you're selling below here, you're just getting out above pretty much any bull bar, and you get follow through on 32, but a tail. Follow through on 33, but a tail. And you can sell the closes or sell below any of these bars. But traders who are doing that are pretty much just trailing a stop above most of the prior bars. 36. So you can sell the close 34, sell the close 35, but it's 5 bear bar micro channel. It's a tight channel, so the first reversal up is probably going to fail. And the first reversal up is 36, and it's a doji bar. So a lot of traders will stay short above 36 since this channel is so tight and should get another leg down. Bad follow through 37, it's a low one, and bear bar 38, but fails to break out and get a strong close below 36. 39, big tail on the top. You can see any bulls who are buying up here disappointed in this, selling out and causing the move down on 39. We're so close to the breakout of the 18 bar range, we probably have to get there. And you can see we break out on 40, and then we try to get a big breakout down on 41, but it fails, and we get a reversal. So it's a failed breakout of the 18 bar range. It could be some sort of parabolic wedge bottom, buying above 41. But if you're buying above 41, it's kind of risky. You need to be willing to sit through a pullback. Bears are probably going to exit above 41, which is reasonable to do. And they do exit above 41, and that's what causes 42. But you got to understand, if you're buying above 41, you need to be pretty quick to get out because, if it doesn't race, it's probably not going to race straight up. And if it doesn't race straight up, this kind of thing can happen, where very quickly it starts to go down, and bulls who are long would just flatten at the market. And so that's why a lot of times you'll start to kind of feel it. You eventually get a feel for the market. But once this bar starts trading down, you immediately start to worry that we're going to get all the way down here. And all the bulls are starting to worry that we're going to get down there because this isn't racing up like they wanted to. And they panic out of longs, and that's what's causing this. 43 is an inside bar and a reasonable swing short. The problem is it might be 1, pullback 2. So it could be 2 legs down, and it could essentially be trend line break and then 2 legs down, and we might get some sort of reversal up. But, I think that this is pretty strong, and it's a reasonable swing short. But you got to note that the trend line is getting more and more parabolic, right? So it makes it more and more likely we're going to end up getting that reversal. And like I said early in the video, look at all these big bull bars, big bull bars, big bull bars, big bull bars, good bull spike. So if, generally rule of thumb, if you're early in a day and it's doing this and going very sideways and you're getting big bars for both sides, then you have to be really suspicious when we get the breakout that the breakout's going to end up failing and you're going to get a reversal back into the range and maybe try to test the open of the day like we did here. 45, some follow through for the bears, and then we get a big follow through bar in 46. Any bear who sold below 45 or sold below 44, sold to close 45, sold below 45, really, happy to get 46 and a pretty quick 5-point scalp. And they even ended up making a little bit more. I mean, if you sold below here, they didn't quite make 10 points, but you can do pretty well if you sell below here, and your true risk is basically 0. It's just the tail on 45. So a lot of traders start scalping out as this gets more parabolic. And that causes the big bull bar on 47. 48's a doji. Bears sold to close at 47, hoping it wasn't going to trigger, and it doesn't trigger. And so, they're happy about that, but it's still their premise that this is going to be a strong bear trend is still not all that valid. That's why when we trade below 48 and get back to the close of 47, basically anywhere down here where bears are selling, those bears are happy to get out during 49, and they're buying back shorts. And some traders, they were willing to get out above 47, and they're disappointed in 48. But when 49 starts trading down, some traders will hold, hoping that we're just going to, we're going to continue to collapse. But when it closes as a doji bar, those traders pretty much give up and they'll buy back their shorts at the market, and that's what's causing the big bull bar on 50. $50 could be a second leg trap for the bulls. 1, pullback 2, and a low 2 short below 51. but I'm not too convinced all the short's all that good. I think at this point a reversal is underway. But if you're buying above 40, 47, you get triggered during 50, and you have to be willing to sit through a pullback because this channel is tight. When you get a really tight channel, even if it's parabolic, a lot of times, you're going to get another leg or two down. But you can see bulls were buying the low. They had a lot of orders to buy down here and defend their low. Why? The same reason traders are buying this close, hoping the bulls don't get out below here. Traders are buying this close, hoping bulls won't get out below here, because they know there are a lot of bull stops here. And so they'll buy down here knowing that if they can drive the market back up, there's a chance of a major trend reversal. It's low probability buying down here, but some traders will do it and put a stop below here. And they have a low probability chance of making a lot of money while risking a little bit. It's not the best idea for individual traders because it's just mentally exhausting to just take trades like this where you're going to lose the vast majority of the time. And then your eventual one winner, you might end up sitting out of. But yeah, anyways, 51, low too short at the top of the trading range, hoping that 50 is a second leg trap. But the downside is probably limited with how strong this, the bull bars are in here and this reversal up. Follow through for the bears on 52, but not all that great, just testing the middle of this tight trading range. 53, it's more follow through for the bears, but again, this bull channel, this bull move makes me think we're going to get another leg up. Bulls try for a double bottom on 54, but it fails on 55. The bulls who bottom above 54, it was risky because you're buying the top of a trading range, right? If you're a bull, you want to buy the bottoms of trading ranges. If you're a bear, you want to sell the tops of trading ranges, like 15. You're selling high in this trading range. And if you're buying above 54, you're kind of buying the top of this trading range. So those traders know that there's a lot of risk if this starts to turn down. And when they get disappointing follow through on 55, a lot of them just sell out at the market and allow 56 to happen because they wanted a big bull bar. They wanted bar 50 on 55. They wanted big follow through. And they don't get it on 55, so they settle their longs at the market, and that causes 56. Some bulls will buy below 55, and they're disappointed in 56, and so when 57 trades up, they scalp out of their longs, and that causes the bar move down to 57. Really think it's a mistake to sell 57. It's too likely it's a second leg trap at the bottom of a trading range, and you have big tails here, only one really strong bear bar, so it's too likely it's a trap. And that's when you get big outside up on 58. Bad follow through on 59 because there's a tail on the top, but then you get another good bull bar on 60. I think bulls buying the close of 59, hoping that the bears won't be able to trigger it. And they also know if you're buying below the close of 59 or willing to buy below it, those traders are willing to scale in, knowing that this is probably a trading range now at the worst case. 60 is potentially a second leg trap, 58, pull back 59, and then 60. But, at this point, you got to be thinking reversals underway. You've been looking for reversal pretty much all through here. So there's a reasonable enough chance that we're going to end up getting a good follow through like we do on 61. The problem with buying 61 is it doesn't close above the overall trading range, 51. So it's a bit disappointing that it doesn't close above that trading range. But it's still a good pair of bull bars enough for a second leg. We get disappointing follow through on 62, and then a really big climactic bar on 63. Now, why do we get a big climactic bar on 63? Well, traders selling, hoping it was a second leg trap, are kind of disappointed that 62 is just a doji bar. If we trade below 62, we might get some sort of move back to this high. That might not be as much of a magnet because 61 might have tested it. But point being, bulls are buying this close, hoping that we're going to get some move like 63. When you get 63, traders are worried it's 1, pullback 2, pullback 3. But at this point, you got to start thinking about the open of the day. And if you're buying above here, I would put a target at the open of the day. And it's a swing trade. It's lower probability that we're going to get all the way up there. But, on trading range days, things aren't as bad as they seem. A lot of, trades like this that don't look as good, can be slightly higher probability. So it's possible that 60 is more of a 50% trade than a 40% trade, especially like once you get 61. I mentioned 64, but bulls will probably be willing to exit below 64 for triggers, but it doesn't trigger because bulls buy the close. We get 65. And disappointing follow through on 66 because this is mostly limit order bulls buying here. So a lot of them will scalp out. Bulls buy below 66 and you get 67. 67 is a high one after 3 pushes up. So probably going to have to get a little more sideways here. That's why we get 68. Bulls will buy below 67 though instead of above. And you can see during 69, if you bought below 67, you almost immediately made a profit that was at least twice your true risk. And that's why, this is twice your true risk and it's a higher probability trade. So a lot of those traders, bulls are hoping that we were going to get to the open of the day, but other bulls who were buying down here ended up scalping out and causing a really disappointing bar in 60, 69. So those traders are disappointed. And some will buy the close of 69, like I mentioned, hoping that we're going to at least get back to this close, or, we're not gonna go straight down, but tough to do. And those traders ended up just scalping out with like a point. And then you get 70, but bulls are buying below 69. Or so you get 71, bulls buying below 69 and 70. 72 trades down below these two breakout points, but it's a big failed breakout on 72. And then 73 tries to start the rally up to the open of the day, but not enough bulls were trapped out yet. You can see 74, 75 are trapping out the rest of those bulls who had their stops below here, and then we got the rally. On the daily chart, we have essentially an inside doji bar today. I think it was a slight bull close. I usually use the SPY for the daily chart, so slight bull close. The reason I use SPY is because the Emini charts can be a little different depending on which contract, so I just like to use SPY because it looks just similar, or to the most current contract anyways. But I think that we're obviously really overbought. This is way more than I was expecting the bulls to do. I was expecting, when we were down here, if you meant, look through my videos in these last couple of days, these couple of days I've been mentioning, I thought we were going to rally. And the more oversold we got, oftentimes the sharper the rally is going to be. Why? Because when you get oversold, traders start thinking that we're going to have a pullback, right? So when you start getting down here, traders are thinking that we're probably going to pull back. And as you get further and further down, traders get tighter and tighter with their stops as they have a larger and larger open profit. So when you start to trade down here, traders will start moving their stops right above bars because they're expecting a pullback, and they know that it can be really sharp because a lot of traders are going to exit really quickly when it starts to rally because everyone begins to expect a pullback. And that's essentially what happened here. This is rare. This is way more than I thought the bulls were going to do. But they did a really good job. But I think the problem is you're now at the top of the trading range. And so I think we're going to go, I think we're going to pull back for a couple legs, maybe for a couple weeks. But ultimately, I think this is going to be a 1, pullback 2 at some point. It might test all the way back down here, though. It definitely could. But I do think we're going to get a second leg up from this to somewhere up in here and then try and form some sort of major trend reversal down. On the weekly chart, I mentioned I thought traders would be disappointed. And you can see those traders who are selling below here are disappointed. But I also think bulls who buy above this bar are going to be disappointed. So I think that, once we trade above last week's high, they're probably going to be sellers there. Tomorrow, I'd be pretty surprised if we break out above this inside bar and just rally straight up. I think that more likely if we break out above this high, it'll be disappointing and we might get some sort of reversal down from yesterday's high. So pay attention to that. Yeah.